I am going to share with you 3 proven strategies to beat the market. These tips will help you navigate both bull and bear markets, so you can win all the time. When I first started investing, I thought beating the market meant finding the next big stock, but I quickly learned it's not that simple. Success doesn't come through guessing. It's about having the right strategies. Over time, I discovered 3 proven ways to navigate both bull and bear markets. And trust me, the third one is truly something else, but it's not for everyone. It's like learning dark magic from Harry Potter. So, if you're ready, let's get started. The first strategy to beat the market is to work with it, not against it. Whether the market is climbing or declining, aligning your investments with the overall trend is critical. Trying to fight against the market is like swimming upstream. It's exhausting, inefficient, and almost always leads to poor results. Let me explain this with a story. Imagine a small bird flying alongside an eagle. The eagle is powerful, cutting through the wind with ease, while the little bird stays tucked under its wing. By doing this, the smaller bird keeps its energy, letting the eagle do most of the work. Occasionally, the bird pops out above the eagle's wing, making it look like it's outpacing the eagle itself. In the stock market, you are the small bird, and the market is the eagle. Instead of fighting against market trends, use them to your advantage. In an uptrend, you can align with the momentum and find opportunities to pop out for even greater gains. Now, how do you make this work for you? Start by focusing on stocks with a beta greater than 1. Beta measures how much a stock moves compared to the market. A stock with a beta above 1 moves more than the market. For example, if the market goes up 1%, a high beta stock might go up 1.5% or even 2%. That extra movement is like the small bird popping out from under the eagle's wing, allowing you to outperform the market. But identifying high beta stocks isn't enough. Timing is everything. Before you invest, confirm the market's trend. Look at major indices like the S&P 500 or NASDAQ. Are they consistently above their 200-day moving average? That's often a signal of an uptrend. If the market is trending upwards, high beta stocks are a great choice because they amplify the gains you're already seeing. What if the market is not in an uptrend? This is where patience comes in. Avoid chasing high beta stocks during a downturn, as they can amplify losses. In such cases, you might want to consider lower beta or defensive stocks instead. Remember, investing is as much about protecting your capital as it is about growing it. Now, let's talk about how to choose the best high beta stocks. First, look for leading sectors. During an uptrend, certain sectors like technology or consumer discretionary often outperform. For example, if tech stocks are booming, look for a high beta stock in that sector. Combining a leading sector with high beta gives you the best chance of maximizing your returns. Second, pay attention to volume and market participation. If a high beta stock has increasing trading volume, it indicates strong investor interest. This can signal a solid opportunity to ride the trend. Finally, keep an eye on broader economic indicators. Are there signs the market might turn? For example, if inflation is spiking or interest rates are rising rapidly, it could signal a slowdown. High beta stocks thrive on momentum, but they can turn against you just as quickly if the market loses its footing. So, working with the market isn't just about picking high beta stocks. It's about understanding trends, timing your investments, and staying adaptable. By following this approach, you're not just trying to beat the market, you're learning how to move with it. Now that we've covered the importance of aligning with the market, let's move to the next step. Choosing stocks with excellent fundamentals to build a portfolio that can weather any storm. The second strategy to beat the market is to focus on stocks with excellent fundamentals. Aligning with the market's trend is crucial, but the stocks you invest in must also be solid at their core. Think of it this way. You wouldn't build a house on a shaky foundation, and you shouldn't build your portfolio on weak companies. So, what makes a stock fundamentally strong? First, look for companies with consistent earnings and sales growth. A business that steadily increases its revenue and profits shows it has a sustainable model and a competitive edge. This consistency is a sign that the company is well managed and delivering on its promises. Second, examine profit margins. High profit margins indicate that the company is managing its costs efficiently while maintaining strong pricing power. In tough times, companies with low margins might struggle to stay profitable, while those with high margins can weather storms and maintain shareholder returns. Next, dive into return on equity, ROE, and return on assets, ROA. These metrics show how well a company is using its resources to generate profit. A consistently strong ROE and ROA, especially above the industry average, signals effective management and operational efficiency. Institutional ownership is another key factor. When mutual funds, pension funds, or other large investors own a significant stake in a company, it's a vote of confidence. These institutional investors do in-depth analysis, so high ownership can be a strong signal of quality. Financial health is also critical. Start with current and quick ratios, which measure a company's ability to meet short-term obligations. Ratios above 1, and ideally higher than 1.5, indicate a company with good liquidity. A healthy debt-to-equity ratio is also important. Companies burdened with excessive debt are vulnerable to rising interest rates or economic downturns, while those with manageable debt have the flexibility to seize opportunities. Earnings per share growth is another must-watch metric. It shows how much profit is being generated per share of stock. Consistent EPS growth indicates that the company is improving its profitability, which directly benefits shareholders. Pair this with solid sales growth, and you have a recipe for success. Don't overlook qualitative factors either. Strong leadership, a clear competitive advantage, or a valuable brand are all signs of a company that's well-positioned to succeed. These elements often separate good companies from great ones. Lastly, look at sector trends. In an uptrend, certain sectors tend to outperform. For example, tech and consumer discretionary stocks often lead the way in bull markets. By choosing companies in leading sectors, you're aligning yourself with another layer of momentum. This approach to stock selection ensures you're investing in businesses that can thrive in both good and bad markets. Combining this with the first strategy of working with the market's trend sets a powerful foundation for your portfolio. Now, let's move on to the third strategy, which is a more advanced way to stabilize and even grow your portfolio during market downturns. You won't want to miss this one. The third strategy to beat the market is more advanced, and I want to start with a big disclaimer. It's not for beginners. If you're new to investing, this might not be the right move for you just yet. But if you're more experienced and comfortable with some risk, this strategy could help you protect your portfolio and even grow it when the market is falling. When markets are in a downtrend, many investors simply hold their positions or move into safer assets like bonds. But what if you could still make money or at least protect yourself when stocks are dropping? That's where shorting the market comes in. Shorting is the process of betting that the price of a stock or an index will go down. Here's how it works. You borrow shares of a stock or an ETF from your broker, sell them at the current market price, and then, if the price drops, you buy those shares back at a lower price to return to the broker. The difference between the selling price and the buying price is your profit. So, how does this fit into your portfolio during a downturn? Imagine you're holding 40 to 50% of your portfolio in broad market ETFs like the S&P 500 or NASDAQ. When the market begins to drop, you can short an ETF that tracks the same index. The idea is that while your long positions lose value, your short position will gain, helping to offset those losses. In other words, shorting can help you stay afloat when the market takes a dive. However, shorting comes with significant risk. If the market moves against your position and starts going up, your potential losses are unlimited, which makes it riskier than simply buying stocks. That's why it's important to use proper risk management. For example, you can use stop-loss orders to automatically close your short position if the market moves in the opposite direction too much, protecting you from huge losses. Another, less risky alternative to shorting is using inverse ETFs. These ETFs are designed to move in the opposite direction of an index. For example, if the S&P 500 falls by 1%, an inverse ETF might rise by 1%. While not as effective as shorting individual stocks, inverse ETFs can still give you a way to profit when the market is down without the complexity of traditional shorting. Timing is everything when it comes to shorting. You should only consider shorting when the market is clearly in a downtrend, typically when the major indexes like the S&P 500 or NASDAQ are below their 200-day moving average. If you jump into shorting too early or too late, it could backfire. One of the psychological challenges of shorting is that it can feel counterintuitive. Most investors are trained to buy and hold, and betting against the market can be uncomfortable. But with the right analysis, confidence, and discipline, shorting can be a powerful tool to hedge against downturns. That said, shorting should never be the main focus of your portfolio. It should only be a small part of your strategy, something you use to help protect your wealth during tough times. Keeping 40 to 50% in diversified, long-term investments like the S&P 500 and using shorting as a tool for balance is the key. To wrap up, shorting the market can be a highly effective strategy to stay ahead during downturns, but it's not without risk. If done with caution and proper risk management, it can help you protect your portfolio or even profit while the market declines. Now that you've got 3 proven strategies to beat the market, it's time to put them into action and start building your wealth. If you're ready to dive even deeper into more advanced investing strategies, check out these videos right here. They'll help you sharpen your skills and stay ahead of the game. And if you haven't already, make sure to like this video, subscribe, and hit the notification bell so you won't miss out on all the latest content. Thanks for watching, and I'll see you in the next video.